Most people assume that when something breaks in the financial system, the largest and most sophisticated players react first. Prices move sharply, volatility explodes, and capital rushes to safety. That assumption feels intuitive. But in reality, the most important signal in macrofinance is often the opposite. When retail investors are anxious, highly reactive, and vocal, and smart money appears calm, patient, or even indifferent, that divergence is rarely accidental. It usually means the system is behaving exactly as designed. And the design is not optimized for speed or emotion. It is optimized for control, compliance, and time. This is the first uncomfortable truth most investors have to confront. Smart money is not trying to predict the next headline. It is not reacting to narratives in real time. It is operating within a structure where outcomes are shaped slowly through rules, incentives, and constraints that are largely invisible to those watching price charts. When retail expects panic and doesn't see it, they assume manipulation, complacency, or denial. But more often, the absence of reaction is itself the signal. It means the adjustment is happening elsewhere, in balance sheets, in regulations, in settlement systems, and in policy frameworks that don't show up in daily price action until much later. To understand why this pattern repeats, it helps to view the financial system not as a market driven by emotion, but as a process driven by stages. In the early stage, stress accumulates quietly. Leverage builds. Liquidity appears abundant. Risk premiums compress. During this phase, participation expands, and retail investors are encouraged by stability rather than warned by it. Nothing looks broken. In fact, everything looks efficient. Smart money doesn't react here because there's nothing to react to yet. The system is still absorbing risk, not releasing it. The second stage begins when imbalances become visible but not disruptive. Credit conditions tighten slightly, volatility rises modestly, isolated failures occur, but they are framed as contained. This is where retail investors often expect a dramatic response, a crash, a policy reversal, or a decisive shift. But instead, smart money slows down. It reduces marginal exposure, lengthens time horizons, and prioritizes flexibility. The absence of visible reaction is intentional. Acting loudly during this stage creates friction. Remaining patient allows the system to do the work of repricing on its own terms. The third stage is administrative. This is the phase most retail investors completely miss. Stress does not resolve through market panic, but through rules. Capital requirements change. Lending standards adjust. Accounting treatment evolves. Regulatory guidance tightens quietly. This is where pressure is applied without force. No one is told to sell, but many are no longer allowed to buy. No assets are seized, but liquidity access narrows. Smart money is deeply active here, but not in public markets. It is repositioning through compliance, not through trades. Only in the fourth stage does visible market reaction occur. By the time volatility spikes or prices gap lower, most institutional adjustments have already been made. The reaction retail investors were waiting for finally arrives, but it arrives after the advantage has shifted. At this point, the system appears to be reacting suddenly, but in reality it is concluding a process that began years earlier. Smart money is not early or late. It is aligned with the system's timeline, not the market's emotions. This pattern is not theoretical. It is repeated across decades. In the late 1990s, during the technology boom, retail investors believed risk was being ignored. Valuations expanded far beyond historical norms, and yet institutional capital remained present. What was misunderstood was that many large players were already reducing exposure through structure, locking in gains, shifting into private vehicles, and allowing public markets to absorb the volatility. When the adjustment came, it appeared abrupt, but the positioning was already done. The same framework applied during the mid-2000s credit expansion. Housing risk did not unwind because investors panicked early. It unwound because lending rules changed, capital requirements shifted, and securitization slowed. The most sophisticated institutions did not short the market loudly. They adjusted quietly. When the visible crisis arrived, it was not the beginning of the unwind. It was the end of the optionality window for those who hadn't prepared. Even sovereign debt crises follow this structure. Before yields spike, before currencies weaken, there is always a period where markets seem strangely calm. That calm is not confidence, it is constraint. Large institutions cannot exit all at once. They need policy coordination, regulatory alignment, and time. The system does not collapse impulsively, it tightens methodically. Applying this framework to today's environment helps explain why expectations and reality feel misaligned. Retail investors are highly attuned to inflation prints, rate decisions, geopolitical headlines, and political narratives. They expect each new data point to trigger immediate repricing. But institutional capital is focused elsewhere. It is focused on settlement mechanics, funding costs, regulatory interpretation, and the durability of cash flows under new constraints. These are not factors that produce dramatic daily moves. They produce gradual reallocation. Modern enforcement does not rely on force or confrontation. It relies on compliance. Banks do not need to be told to reduce risk. If capital charges make certain assets uneconomical, funds do not need to be banned from strategies if reporting requirements make them operationally unattractive. Pressure is applied through margin rules, liquidity coverage ratios, collateral eligibility, and supervisory guidance. None of this looks dramatic on a chart, but all of it changes behavior. This is why smart money often appears inactive during periods of stress. It is not frozen. It is navigating a system where the cost of being early is often higher than the cost of being patient. Acting too soon invites scrutiny. Acting too loudly reduces optionality. Waiting allows rules to do the work. Under this system, beneficiaries are those with flexibility. Institutions with diverse funding sources, long-duration capital, and regulatory expertise gain advantage. They can absorb volatility without needing to react. They can wait for assets to reprice under pressure rather than chase momentum. They benefit from stability, not disruption. Those who lose are not necessarily wrong. They are fragile. Participants who rely on leverage, short-term liquidity, or narrative timing are exposed to administrative shifts they cannot anticipate. When rules change, they are forced to act. When access tightens, they lose optionality. Losses do not come from bad predictions, but from inflexibility. The most important implication is that visible calm does not mean risk has disappeared. It means risk has been redistributed. It has moved from price to structure, from volatility to access, from markets to rules. Retail investors often interpret this as complacency. In reality, it is maturity. The system is not trying to surprise participants. It is trying to constrain them gradually. For individuals observing this dynamic, the takeaway is not to predict the next crisis or chase protection aggressively. It is to reduce fragility. That means prioritizing liquidity, avoiding forced decisions, and maintaining flexibility in time horizons. Optionality matters more than precision. Being able to wait is more valuable than being right early. As the system continues to evolve, reactions will remain uneven. Some moves will look delayed, others will look sudden, but none of it will be random. The framework remains intact. Stress accumulates quietly. Adjustments happen administratively. Markets react last. In the next phase of this discussion, I'll examine how this process is playing out in specific asset classes today, and why the most important shifts are happening where few people are looking. When we narrow the lens from theory to the present moment, the disconnect between retail expectations and institutional behavior becomes clearer. Many investors are watching prices, headlines, and sentiment indicators, waiting for an obvious breaking point. But the system is not signaling stress through spectacle. It is signaling stress through friction. Funding is more expensive, balance sheets are more constrained, and optionality is being quietly rationed. None of this requires dramatic market moves to be effective. Consider the role of central banking in this environment. The Federal Reserve is often viewed as a lever that directly moves markets through announcements. But in practice, its most powerful influence is indirect. Policy rates matter less than how those rates propagate through collateral markets, bank reserves, and regulatory capital. When liquidity is abundant, markets absorb shocks easily. When liquidity is technically present but operationally constrained, reactions slow. This is the environment we are in now. Retail investors often expect that tighter policy should immediately produce visible stress. Falling equity prices, widening credit spreads, or forced selling. But large institutions are not positioned to react reflexively. Their exposure is governed by internal risk models, regulatory thresholds, and funding structures that change gradually. What looks like indifference is actually recalibration. Risk is being reduced not by selling assets outright, but by declining to add new exposure, shortening balance sheets, and prioritizing assets with favorable regulatory treatment. This is where modern enforcement becomes central to the story. Financial systems no longer rely on blunt interventions. Instead, pressure is applied through layers of compliance. Capital adequacy frameworks like Basel III do not prohibit risk-taking, but they make certain risks expensive to hold. Liquidity coverage ratios do not force banks to sell, but they discourage long-dated or illiquid positions. Margin requirements do not ban leverage, but they make it conditional and fragile. None of these mechanisms trigger headlines. They do not create panic, but they steadily reshape behavior. Institutions respond not because they fear losses tomorrow, but because the cost of maintaining certain positions rises today. Over time, this produces a market that looks stable on the surface, but is increasingly selective underneath. We can see this dynamic across asset classes. In equities, index-level resilience masks internal divergence. Capital concentrates in companies with strong cash flows, low refinancing risk, and favorable treatment under accounting and regulatory frameworks. More speculative or capital-intensive firms are not collapsing. They're being starved of incremental capital. Retail investors waiting for a broad sell-off miss the more important signal: opportunity is narrowing. In fixed income, yields have adjusted, but the more significant change is in market depth. Dealers intermediate less. Inventories are smaller. Liquidity exists, but only at wider spreads and lower size. For institutions, This is manageable. Trades are planned, staggered, and structured. For smaller participants, it creates the illusion that markets are fine, until they aren't. Again, the adjustment is administrative before it is visible. Globally, the same framework applies. Sovereign markets are not unraveling because policy coordination and regulatory alignment delay disorderly moves. But that does not mean stress is absent. It means stress is being absorbed through slower growth, tighter financial conditions, and reduced cross-border risk-taking. Capital does not flee overnight, it becomes selective. That selectivity benefits those with scale and endurance. Who benefits most under the system is not determined by foresight, but by resilience. Institutions with stable funding, diversified revenue, and regulatory expertise gain time. They are not forced to act. They can wait for repricing to come to them. This is why smart money often appears late to narratives, but early to outcomes. It is positioned to benefit from constraints rather than fight them. Those who lose are not necessarily reckless. They are exposed to timing risk. Participants who depend on continuous liquidity, frequent refinancing, or narrow strategies find themselves constrained by rules they did not anticipate. Losses emerge not from dramatic mistakes, but from being forced to act at unfavorable moments. In a system governed by compliance, being forced is the ultimate disadvantage. This brings us to the most practical part of the discussion. For individuals navigating this environment, the goal is not to outsmart institutions or predict turning points. It is to align with the system's incentives rather than its noise. That means favoring simplicity over complexity, liquidity over leverage, and durability over optimization. Reducing fragility does not require abandoning risk. It requires structuring exposure so that time works in your favor rather than against you. Optionality is the quiet advantage. Having the ability to wait, to adjust, and to absorb uncertainty without forced decisions is more valuable than precision forecasting. In a system that moves administratively, patience is not passive. It is strategic. The most important risk is not missing an opportunity, but losing flexibility. As we move forward, the gap between perception and reality may widen. Markets may continue to look calm even as constraints tighten. Retail narratives may grow louder even as institutional behavior grows quieter. That divergence is not a mystery. It is the system functioning as designed. In the next video, we'll take this framework one step further and examine where stress tends to surface last and why the final phase of adjustment often surprises those who thought they were watching closely.